CPA, ATD, 𝐉𝐻𝐶, CS, and other 𝐎𝐍𝐋 professional courses designed to take you to the next level. With expert tutors, flexible online learning, and timely syllabus coverage, success starts here. Enroll now and take charge of your future with Focus Online College, your partner in professional excellence. Call us today on 07194511155 or 01166422200 to register. The September-December 2025 semester is here and our classes have officially started. Don't wait until it's too late. Secure your slot today with a commitment fee of only 2,000 Kenyan shillings per unit. We offer CPA, ATD, 𝐉𝐻, CS, and other 𝐎𝐍𝐋 professional courses designed to take you to the next level. With expert tutors, flexible online learning, and timely syllabus coverage, success starts here. Enroll now and take charge of your future with Focus Online College, your partner in professional excellence. Call us today on 07194511155 or 01166422200 to register. The September-December 2025 semester is here and our classes have officially started. Don't wait until it's too late. Secure your slot today with a commitment fee of only 2,000 Kenyan shillings per unit. We offer CPA, ATD, 𝐉𝐻, CS, and other 𝐎𝐍𝐋 professional courses designed to take you to the next level. With expert tutors, flexible online learning, and timely syllabus coverage, success starts here. Enroll now and take charge of your future with Focus Online College, your partner in professional excellence. Call us today on 07194511155 or 01166422200 to register. The September-December 2025 semester is here and our classes have officially started. Don't wait until it's too late. Secure your slot today with a commitment fee of only 2,000 Kenyan shillings per unit. We offer CPA, ATD, 𝐉𝐻, CS, and other 𝐎𝐍𝐋 professional courses designed to take you to the next level. With expert tutors, flexible online learning, and timely syllabus coverage, success starts here. Enroll now and take charge of your future with Focus Online College, your partner in professional excellence. Call us today on 07194511155 or 01166422200 to register. The September-December 2025 semester is here and our classes have officially started. Don't wait until it's too late. Secure your slot today with a commitment fee of only 2,000 Kenyan shillings per unit. We offer CPA, ATD, 𝐉𝐻, CS, and other 𝐎𝐍𝐋 professional courses designed to take you to the next level. With expert tutors, flexible online learning, and timely syllabus coverage, success starts here. Enroll now and take charge of your future with Focus Online College, your partner in professional excellence. Call us today on 07194511155 or 01166422200 to register. The September-December 2025 semester is here and our classes have officially started. Don't wait until it's too late. Secure your slot today with a commitment fee of only 2,000 Kenyan shillings per unit. We offer CPA, ATD, 𝐉𝐻, CS, and other 𝐎𝐍𝐋 professional courses designed to take you to the next level. With expert tutors, flexible online learning, and timely syllabus coverage, success starts here. Enroll now and take charge of your future with Focus Online College, your partner in professional excellence. Call us today on 07194511155 or 01166422200 to register. The September-December 2025 semester is here and our classes have officially started. Don't wait until it's too late. Secure your slot today with a commitment fee of only 2,000 Kenyan shillings per unit. We offer CPA, ATD, 𝐉𝐻, CS, and other 𝐎𝐍𝐋 professional courses designed to take you to the next level. With expert tutors, flexible online learning, and timely syllabus coverage, success starts here. Enroll now and take charge of your future with Focus Online College, your partner in professional excellence. Call us today on 07194511155 or 01166422200 to register. The September-December 2025 semester is here and our classes have officially started. Don't wait until it's too late. Secure your slot today with a commitment fee of only 2,000 Kenyan shillings per unit. We offer CPA, ATD, 𝐻𝐶EFA, CS and other 𝐻𝐶 professional courses designed to take you to the next level. With expert tutors, flexible online learning, and timely syllabus coverage, success starts here. Enroll now and take charge of your future with Focus Online College, your partner in professional excellence. Call us today on 07194511155 or 01166422200 to register. The September-December 2025 semester is here and our classes have officially started. Don't wait until it's too late. Secure your slot today with a commitment fee of only 2,000 Kenyan shillings per unit. We offer CPA, ATD, 𝐻𝐶EFA, CS and other 𝐻𝐶 professional courses designed to take you to the next level. With expert tutors, flexible online learning, and timely syllabus coverage, success starts here. Enroll now and take charge of your future with Focus Online College, your partner in professional excellence. Call us today on 07194511155 or 01166422200 to register. The September-December 2025 semester is here and our classes have officially started. Don't wait until it's too late. Secure your slot today with a commitment fee of only 2,000 Kenyan shillings per unit. We offer CPA, ATD, 𝐻𝐶EFA, CS and other 𝐻𝐶 professional courses designed to take you to the next level. With expert tutors, flexible online learning, and timely syllabus coverage, success starts here. Enroll now and take charge of your future with Focus Online College, your partner in professional excellence. Call us today on 07194511155 or 01166422200 to register. The September-December 2025 semester is here and our classes have officially started. Don't wait until it's too late. Secure your slot today with a commitment fee of only 2,000 Kenyan shillings per unit. We offer CPA, ATD, 𝐻𝐶EFA, CS and other 𝐻𝐶 professional courses designed to take you to the next level. With expert tutors, flexible online learning, and timely syllabus coverage, success starts here. Enroll now and take charge of your future with Focus Online College, your partner in professional excellence. Call us today on 07194511155 or 01166422200 to register. The September-December 2025 semester is here and our classes have officially started. Don't wait until it's too late. Secure your slot today with a commitment fee of only 2,000 Kenyan shillings per unit. We offer CPA, ATD, 𝐻𝐶EFA, CS and other 𝐻𝐶 professional courses designed to take you to the next level. With expert tutors, flexible online learning, and timely syllabus coverage, success starts here. Enroll now and take charge of your future with Focus Online College, your partner in professional excellence. Call us today on 07194511155 or 01166422200 to register. The September-December 2025 semester is here and our classes have officially started. Don't wait until it's too late. Secure your slot today with a commitment fee of only 2,000 Kenyan shillings per unit. We offer CPA, ATD, 𝐻𝐶EFA, CS and other 𝐻𝐶 professional courses designed to take you to the next level. With expert tutors, flexible online learning, and timely syllabus coverage, success starts here. Enroll now and take charge of your future with Focus Online College, your partner in professional excellence. Call us today on 07194511155 or 01166422200 to register. The September-December 2025 semester is here and our classes have officially started. Don't wait until it's too late. Secure your slot today with a commitment fee of only 2,000 Kenyan shillings per unit. We offer CPA, ATD, 𝐓𝐹A, CS, and other 𝐎𝐍𝐋 professional courses designed to take you to the next level. With expert tutors, flexible online learning, and timely syllabus coverage, success starts here. Enroll now and take charge of your future with Focus Online College, your partner in professional excellence. Call us today on 07194511155 or 01166422200 to register. The September-December 2025 semester is here, and our classes have officially started. Don't wait until it's too late. Secure your slot today with a commitment fee of only 2,000 Kenyan shillings per unit. We offer CPA, ATD, 𝐓𝐹A, CS, and other 𝐎𝐍𝐋 professional courses designed to take you to the next level. With expert tutors, flexible online learning, and timely syllabus coverage, success starts here. Enroll now and take charge of your future with Focus Online College, your partner in professional excellence. Call us today on 07194511155 or 01166422200 to register. The September-December 2025 semester is here, and our classes have officially started. Don't wait until it's too late. Secure your slot today with a commitment fee of only 2,000 Kenyan shillings per unit. We offer CPA, ATD, 𝐓𝐹A, CS, and other 𝐎𝐍𝐋 professional courses designed to take you to the next level. With expert tutors, flexible online learning, and timely syllabus coverage, success starts here. Enroll now and take charge of your future with Focus Online College, your partner in professional excellence. Call us today on 07194511155 or 01166422200 to register. The September-December 2025 semester is here, and our classes have officially started. Don't wait until it's too late. Secure your slot today with a commitment fee of only 2,000 Kenyan shillings per unit. We offer CPA, ATD, 𝐓𝐹A, CS, and other 𝐎𝐍𝐋 professional courses designed to take you to the next level. With expert tutors, flexible online learning, and timely syllabus coverage, success starts here. Enroll now and take charge of your future with Focus Online College, your partner in professional excellence. Call us today on 07194511155 or 01166422200 to register. The September-December 2025 semester is here, and our classes have officially started. Don't wait until it's too late. Secure your slot today with a commitment fee of only 2,000 Kenyan shillings per unit. We offer CPA, ATD, 𝐓𝐹A, CS, and other 𝐎𝐍𝐋 professional courses designed to take you to the next level. With expert tutors, flexible online learning, and timely syllabus coverage, success starts here. Enroll now and take charge of your future with Focus Online College, your partner in professional excellence. Call us today on 07194511155 or 01166422200 to register. The September-December 2025 semester is here, and our classes have officially started. Don't wait until it's too late. Secure your slot today with a commitment fee of only 2,000 Kenyan shillings per unit. We offer CPA, ATD, 𝐓𝐹A, CS, and other 𝐎𝐍𝐋 professional courses designed to take you to the next level. With expert tutors, flexible online learning, and timely syllabus coverage, success starts here. Enroll now and take charge of your future with Focus Online College, your partner in professional excellence. Call us today on 07194511155 or 01166422200 to register. The September-December 2025 semester is here, and our classes have officially started. Don't wait until it's too late. Secure your slot today with a commitment fee of only 2,000 Kenyan shillings per unit. We offer CPA, ATD, 𝐓𝐹A, CS, and other 𝐎𝐍𝐋 professional courses designed to take you to the next level. With expert tutors, flexible online learning, and timely syllabus coverage, success starts here. Enroll now and take charge of your future with Focus Online College, your partner in professional excellence. Call us today on 0719451155 or 01166422000 to register. The September-December 2025 semester is here and our classes have officially started. Don't wait until it's too late. Secure your slot today with a commitment fee of only 2,000 Kenyan shillings per unit. We offer CPA, ATD, 𝐻𝐶EFA, CS and other 𝐎𝐍𝐋𝐈𝐍 professional courses designed to take you to the next level. With expert tutors, flexible online learning, and timely syllabus coverage, success starts here. Enroll now and take charge of your future with Focus Online College, your partner in professional excellence. Call us today on 0719451155 or 01166422000 to register. The September-December 2025 semester is here and our classes have officially started. Don't wait until it's too late. Secure your slot today with a commitment fee of only 2,000 Kenyan shillings per unit. We offer CPA, ATD, 𝐻𝐶EFA, CS and other 𝐎𝐍𝐋 professional courses designed to take you to the next level. With expert tutors, flexible online learning, and timely syllabus coverage, success starts here. Enroll now and take charge of your future with Focus Online College, your partner in professional excellence. Call us today on 0719451155 or 01166422000 to register. The September-December 2025 semester is here and our classes have officially started. Don't wait until it's too late. Secure your slot today with a commitment fee of only 2,000 Kenyan shillings per unit. We offer CPA, ATD, 𝐻𝐶EFA, CS and other 𝐎𝐍𝐋 professional courses designed to take you to the next level. With expert tutors, flexible online learning, and timely syllabus coverage, success starts here. Enroll now and take charge of your future with Focus Online College, your partner in professional excellence. Call us today on 0719451155 or 01166422000 to register. The September-December 2025 semester is here.
In a company which is called 𝐻𝐻 Limited, on which date? 1st of April 2024. 1st of April 2024. It basically means that 𝐿OC is the parent and then 𝐻𝐻 is the subsidiary. You can see also we're given the date of acquisition. Then from there, I want us to go to the paragraph number 3. Let's go to paragraph 3. We skip paragraph 2. In paragraph number 3, we are told on 1st of October 2024, 𝐿OC Limited, our parent company, with another entity entered into a joint arrangement to jointly control 𝐶SAS Limited, a public limited entity. Effectively, 𝐿OC Limited purchased 50% of the equity shares of what? Of 𝐶SAS for an immediate cash payment of 15. So this company here, we are told acquired 50% shareholding in a company which is called 𝐶SAS Limited. 𝐶SAS Limited on which date? 1st of October 2024. 1st of October 2024. So it basically means that from this group structure, this will be our parent company, this will be our subsidiary, and basically this one will be a joint venture. That one will be a joint what? A joint venture. So that is the first thing you always need to have, because this is basically what will guide you in terms of how to prepare the group account. So if we go to the requirements, therefore, we are required to prepare the consolidated statement of profit or loss, consolidated statement of financial position. So in preparing those consolidated financial statements, we will add similar items of assets and liabilities, those of the parent, those of the subsidiary. That does not apply to the joint venture. For the joint venture, in the consolidated statement of profit or loss, we will compute the parent company share of profit after tax, another comprehensive income, and also we compute something called the investment in what? In joint venture, or the investment in joint arrangement. This one, we can also refer to it as a joint arrangement, because the parent company have a joint arrangement with another company to control this, to jointly control that one. So I think we have that. Then we will be able to come back to that paragraph 2, because we have the aspect of deferred consideration, but we will only come back there when computing the goodwill. So that deferred consideration, remember we said we have to discount it to its present value using the parent company cost of capital. That's why you can see you're given the cost of capital of 𝐼𝐶 Limited. That is for the purpose of getting the present value of that. So I want us to go to the additional information now. Let's go to note number 1. And in note number 1, what are we told? We are told at the date of acquisition. At the date of acquisition, the fair value of Paper Limited, remember Paper now is the subsidiary. Paper Limited net asset approximated their carrying amount with an exception of some office equipment whose carrying amount was 560 million below the fair value. And then you're told at this date, the office equipment had a remaining economic useful life of 8 years. And then you're told depreciation on office equipment is an administrative cost. And then you're told no fair value adjustment were necessary in the acquisition of 𝐶𝐶. What does that mean? It means that on the date this company was acquired, that is the subsidiary company revalued the assets. Revalued the asset. And if you can be able to recall, we refer to that as the fair value adjustment or the fair value exercise. And actually we said once the subsidiary company revalued the asset, the subsidiary company does not account for that revaluation. As a result of that, when preparing the group account, we talked about 2 key consolidation adjustments we make. The first one is called the revaluation adjustment, which is an adjustment relating to the revaluation gain, and the other one is depreciation adjustments, whereby you have to compute depreciation and the charge. So therefore, we need to do some working as far as that is concerned. Note 1 is concerned, which you are saying is a fair value adjustment, or basically the fair value exercise. Let's just refer to it as the fair value adjustment, and this is by Paper Limited. By Paper Limited. So we need to make 2 adjustments as far as this is concerned. The first one is called the revaluation adjustment, and basically this is the adjustment in relation to the revaluation gain or loss. But remember, you see in most of the questions for group account, you'll come across a revaluation gain. So that's why we are told in the first paragraph, in the first sentence of note 1, we are told at the date of acquisition, the fair value of Paper Limited net asset approximated the carrying amount with an exception of an item of office equipment whose carrying amount was 560 million below. So this one was below or was less than fair value with 560 million. In other terms here, we can say the fair value, we start with the fair value, then we change this inequality sign. Remember, this was less than. So we change this now to greater than. If we start with this, so this one will be greater than carrying amount with an amount of what? 560. So if the fair value of an asset is more than its carrying amount, automatically that is a revaluation gain. So the fair value of this item of office equipment was more than carrying amount. Remember, carrying amount, this one can also be known as the net book value with an amount of 560 million. So because this revaluation, okay, this 561, we are saying this is a revaluation gain. This is a revaluation gain by Paper. Did the Paper Limited accounted for this revaluation gain? No. So therefore, in preparing the consolidated financial statement, this one will be added to the group PPE. And number 2, we say that this one is a pre-acquisition revaluation reserve. Being a pre-acquisition revaluation reserve, we use that in the computation of goodwill, because we say in computing the goodwill on acquisition of this, we need to have we need to compute its fair value. We need to compute the fair value of its net asset on the date of acquisition. How do we compute that? We take the ordinary share capital of the subsidiary plus pre-acquisition reserves. This will be one of the pre-acquisition reserve. Next, we need to compute something called the depreciation other charge. Depreciation other charge. And equally this depreciation other charge will be by Paper, is by Paper Limited. So you need to recall the formula. There is a formula which I gave you here. That is basically what you need to remember. We said we take the revaluation gain, divided that with the remaining useful life of the asset, and then we multiply this with what? With the proportion of time. The proportion of time is basically the time we have, or basically the number of years, the number of months we have, from the date of acquisition, the date of DOA, to the date of consolidation. Remember, the date of acquisition is the date the subsidiary was acquired. The subsidiary was acquired on which date? There, 1st of April 2024. The date of consolidation, this one, DOC, this is the date we are required to prepare the group accounts. And if you go to the requirement, you'll be able to see when are we required to prepare the group accounts as per the requirement. The year which ended 31st of March 2025. So that is the date of consolidation. And actually this year, because the year of the group is ending at 31st of March, it starts on 1st of April. So this year started on 1st of April, 2024. So therefore you can see our subsidiary here was acquired exactly at the start. Was acquired exactly at the start of what? Of the year. So therefore, the proportion of time we have here will be 1 year. Will be one what year? We're interested with the depreciation other charge for 1 year. We will take the revaluation gain, which we have here, 560 million. We are applying this formula. We divide that with the remaining useful price. And I hope you can see that within note 1. Can you see the remaining useful price? How many years? In note 1, remaining useful price. In note 1, how many years? Who can see that? Who can see that? Who can see that? 8 years. The remaining useful price of that asset, can you see that? Should be 8 what? 8 years. 8 years. So we divide that with 8. And then the proportion of time here we are saying is 1 what? Is 1 year. If, for example, in our case, we had 6 months here, we had 6 months. So then the proportion of time here is always 6 over 12. If we had, for example, 2 years, we're interested in the depreciation under charge for 2 years. Our proportion of time should be 2. Should be what? 2. But in our case, we're interested with depreciation under charge for how many years? For 1 year. For 1 year. For 1 year. So this will give us 70 million. Now, this 70 million, which items will be adjusted here? One, this one will be deducted from the group PPE. When preparing our consolidated statement of financial position, we left that from the PPE. Number 2, we will also deduct this from the retained earnings of which company? Of paper. Retained earnings of paper. And number 3, in preparation of the consolidated income statement, because we are required to prepare that, the consolidated statement of profit or loss, this one will be adjusted where we have said any depreciation under charge should be added to the cost of sales unless otherwise. If you check on the information which are given in note number 1, we are told that depreciation of the office equipment is an administrative expense. Are we going to add this to the cost of sales? No. No. So in this case, we will add this depreciation under charge to what? To the administrative expenses. To the administrative what? Expenses. But if the question was cited, that one should be added to the cost of sales. So we are done with that. This is something which you have to understand because in all questions for group account, you will come across this particular concept that the subsidiary company revalued the asset but never accounted for that. Which adjustments are required? 2, the revaluation gain and the depreciation under charge. Let's move to point number 2, where we are told 𝐿𝐿 Limited, which is basically the parent, measures the non-controlling interest in subsidiaries at the fair value. This is something I explained that if you come across that information that it is a policy of the group, it is a policy of the parent company to measure NCI at fair value, that information is basically to help you in computation of goodwill. And who can tell us, based on that information, which method are we going to use in the computation of goodwill? The goodwill on acquisition of this subsidiary. Which method are we going to use? Are we going to use the partial goodwill method? Are we going to use the full goodwill method? Which method are we going to use based on that information which we have there? Based on that information, which method are we going to use? Maureen, Georgina, which method? Benson, Gilbert, which method are we going to use? Automatically, we are going to use the full goodwill method. The full goodwill what? Method. That's why still in point number 2, we are told the fair value of the non-controlling interest of paper limited at the date of acquisition was 860. That is for the purpose of computing what? The goodwill. That is the NCI fair value. So no working which is required there. Let's move to point number 3. And you're told during the year which ended 31st of March 2023, Paper Limited sold goods to 𝐿𝐿 Limited for shillings 500 million at a markup on cost of 25%. First of all, this goods which was sold by Paper Limited to 𝐿𝐿, Paper Limited to 𝐿𝐿, this one we refer to that as amount of intragroup trading or intragroup sales. Intragroup trading. And basically we are told the goods which were sold by paper to 𝐿𝐿 they had a value of 500 million. So basically, we have said that these sales between the parent and the subsidiaries are fixed sales. So therefore, this one will be deducted from the group revenue. This one will be deducted from the group revenue. And number two, we will also deduct this from the group cost of sales. Group revenue and also group cost of what? Of sales. So then in the same point, we are told half of these goods were still held by Rock Limited as at the end of the year, and the balance payable was still outstanding, and the balance payable was still what? Outstanding. Now, in that case, we have two adjustments here. The first adjustment is adjustment for unreleased profit and also adjustment for amount of intercompany debt. I want us, first of all, we deal with we compute the amount of unreleased profit, amount of unreleased profit. So unrealized profit on inventory. Remember, unrealized profit, we said arises whereby we have sales between the parent and subsidiary, and some of the goods sold to the buying company will not have been sold to third parties. In that point, we are told that this company, which is called Paper, our subsidiary, sold some goods now to Lock, but basically some of the goods remained in the inventory of Lock. They were not yet sold to third parties. We need to compute the unrealized profit, and this unrealized profit is always by the selling company. The selling company is this one. So this is unrealized profit by Paper. So how do we compute this unrealized profit? We take the unsold goods times the gross profit margin. Times the gross profit what? Margin. That is the formula you need to remember. The formula for computing what? For computing the amount of unrealized what? Unrealized profit. So let's proceed and we compute the unrealized profit basically by applying this formula here. We will take the unsold goods, and in that case, we are told the goods not yet sold at the end of the year were half. Half of these goods were still held in the inventory of Rock. The unsold goods would be half of the goods which were sold by Paper to Lock, which is basically 500 million. These are the unsold goods. The unsold goods, we multiply that with the gross profit margin. The gross profit margin, is it given? No. What we are given in our question, we are given the gross profit markup. Gross profit markup is 25%, which is basically the same with a quarter. Which is the same with what? A quarter. So having this, can we be able to determine the gross profit margin? Who can tell us which will be our gross profit margin here? Our gross profit margin, I'm told by Gilbert, will be 20%. As a fraction, it will be equal to what? As a fraction, automatically that one would be a quarter. And then to the denominator, we add the numerator. It will be 1/5. So this one will be the margin, will be 1/5. So how much will be our unreleased profit here? So it will be half to 50, and basically that will be 50 million. So this unreleased profit number one, this will be deducted from the group inventory. In preparing our consolidated balance sheet, we let's start from the group revenue. Number two, this one will also be deducted from the retained earnings of the selling company. The selling company is Paper. That one will be deducted from the retained earnings of Paper. And then in preparation of the consolidated statement of profit or loss, this one we have said should be added to the group cost of sales. Those are the three adjustments which will be made as far as that and his profit is concerned. So we are done with point number 3. But even before you move to point number 4, in the last part of that, point number 3, we are told and the balance payable was still outstanding. The balance payable was still outstanding. What is that? Balance payable was still outstanding. What is that? Who can tell us? Balance payable was still outstanding. Basically, that is the amount of intercompany debt. Now, if this company sells some goods to this, so it is obvious that this company, the parent company, should pay who? Should pay the subsidiary. But in this case, we are told the balance payable the balance payable was still what? Was still outstanding. So how much will be the balance which was payable? The balance payable. The balance payable should be what? The balance payable will be what? The balance payable here will be 500,000, 500 million, 500 million, that is, because the amount of money which 𝐓𝐿 Limited was supposed to pay paper was 500 million. So this amount is the one which amount to, or which amount to, or is the amount of intercompany debt. Amount of intercompany what? Debt. So in this case, it will be 500 million. So this one will be deducted from the group receivables, and also it will be deducted from the group what? Payables. Group receivables and group what? Payables. We move to point number 4, and we are told impairment review performed on 31st of March 2024, that is at the end of the year, basically reveals that both goodwill on acquisition and on paper limited and the interest in CSAS were unimpaired. So the goodwill on acquisition of this, the investment in the joint venture were not yet impaired. So no working which is required. Number 5, incomes and expenses of the group of the companies are deemed to have accrued evenly throughout the year. So that information is always given such that if there is something you need to apportion on time basis or something you need to apportion, you apportion it on time basis. You apportion it on time what? Basis. And I think having said, there is something we need to compute before we proceed to prepare what is required. I want us to compute the goodwill on acquisition because there is something we will compute there. Let's first of all, we compute the goodwill on acquisition of this company here. Remember, I said we only compute the goodwill on acquisition of the subsidiary and we recognize that as an asset within the consolidated statement of financial position. The goodwill on acquisition of joint venture, the goodwill on acquisition of the associate is not computed and recognized as an asset within what? The consolidated statement of financial position. So let's compute the goodwill. The goodwill on acquisition of this company, that is paper, paper limited, as per the information we have in note number 2, we are using the full goodwill method. We are using the full goodwill method, So here we need to have 2 columns, and our figures are in million of shillings. I hope you can be able to remember how we compute the goodwill using the full goodwill method. We start with the purchase consideration, which was paid by the parent company. The purchase consideration paid by the parent company. The purchase consideration paid by the parent company, this one is given within paragraph 2. Paragraph 1 and 2. Let's go back to paragraph 1 and 2 of our question. So first of all, we go to paragraph 1. Actually, paragraph 2, not paragraph 1. Paragraph 2. We are told the acquisition consideration. This is the acquisition of the subsidiary. The acquisition consideration consisted of an immediate cash payment of 2,400 million. So the parent company paid the purchase consideration. The purchase consideration paid by the parent company was in 2 forms. The cash consideration, and I hope you can be able to recall, we say that this one do not have any special treatment. That amount we are going to use it as 2,400 million. So an immediate cash payment of 24. And this one, if you go to the balance sheet or the statement of financial position of the parent, and the non-current asset, you should be able to see that amount. So the moment the parent company has paid some cash consideration in acquiring a subsidiary, that is accounted for as an investment in the statement of financial position of the parent. I hope you can see that, 24. And then we also have a deferred consideration. The deferred consideration. So the deferred consideration still in that paragraph 2, we are told an immediate cash payment of 24 and on 1st April 2024, and a further consideration of that 31 million deferred until 1st of April 2026. No accounting entries have been made in respect of the deferred cash consideration, and 𝐓𝐿 Limited cost of capital is 10%. These are deferred considerations which we said should be discounted to its present value using the parent company cost of capital. So we are going to discount that to the present value. So we will take 1331, and basically we discount this to the present value by multiplying that with the present value interest factor at the rate of 10%. And basically for how many years? How many years do we have from the date of acquisition? 1st of April 2024. This is the date of acquisition. That consideration will be paid on 1st of April 2026. How many years do we have here? How many years do we have there? Yes, we have 2. We have the first year which will end first, or basically 1st April 2025, 1, 2. So for 2 years. So this one will be computed like this. We take 1. Remember the formula here. 1.1 raised to power negative 2. Yes, basically that's how we discount this. 1.1 raised to power negative 2, raised to power negative 2, raised to power negative 2. That's basically how we are going to discount that. Times 1331. And basically that one is coming to 1100. Is that what you're getting? 1100? 1100. 1100. 1100. Is that what you're getting? Diana, is that what you're getting? Georgina, is that what you're getting? Is that what you're getting? Yes. Okay, so then this is basically the purchase consideration paid by the parent. And then now to this, what we need to do? We need to add the NCI at fair value. Remember, you're using the full goodwill method. The NCI at fair value, this one is given in note number 2. Is given in note 2. So the NCI at fair value is 860. 860. So we need to add those 3 values so that then we proceed and we less the net assets, which one? According basically, I'm told that this one will give us 4360. 4360. Okay. So then to this, what do we need to do? To this, we need to proceed and we less the fair value of net assets which were acquired. So remember, you say that this is one of the items which the examiner will not have given you, and this whereby majority of the students have a challenge. How do we compute this? We say to compute this, we take the ordinary share capital of the subsidiary plus pre-acquisition reserves. Plus pre-acquisition reserves. So what we do, we have to go to the balance sheet of the subsidiary, specifically at the equity. Can we go to the balance sheet of the subsidiary? Subsidiary is paper, specifically at the equity. At the equity, we start by taking its ordinary share capital. Its ordinary share capital was, or is basically 2,000. Below that, what do we have? We have share premium. In this case, if we are given a share premium in the balance sheet of the subsidiary, and the question is silent, the question is what? Silent. We always treat that as a pre-acquisition. We always treat it as what? As a pre-acquisition. And then from there, we have the retained earnings. The retained earnings. But basically, what we know is that that retained earnings which we have there, that is the retained earnings at the end of the year. So what we are interested with here is the retained earnings on the date of acquisition, because this is a reserve. This is a reserve. We're interested with the retained earnings on the date of acquisition. And basically what we know, I've said that the retained earnings which are given here of 1,800, this is the retained earnings at the end of the year, 31st of March 2025. So we are interested with the retained earnings of paper on the date of acquisition here, 1st of April 2024. How do we get that? Very simple. Because one, we know the retained earnings of this company for the current year. In other terms, what is the profit after tax of paper? So the retained or the profit after tax of this company during the current year. So you get that from the income statement. Can we go to the income statement of paper? The income statement of paper, you tell me how much was its profit for the current year. How much is the profit after tax for the current year for paper? Can you see that amount? It is 520. It is 520. So how do we arrive at this value here, the retained earnings at the end? To arrive at this, we take the retained earnings at the start, which we don't have. We add this, we get this. Sasa, we take this plus this, we get this. What we are interested with is the retained earnings on this date. So can we be able to get this? Take into account to get this, We take this plus this, we get this. It's very simple. So to get this one, we will take this minus this, we get that. So therefore, the retained earnings at the start will be 1800 minus 5 what? 20. And this will give us 12 what? That will give us 1280. 1280. So 1280 is basically the retained earnings on the date of acquisition. And therefore, if you check there, we don't have any other stuff. But in all this particular question for group account, there is something you must always remember to check. Did the subsidiary company revalue the asset on the date of acquisition? If yes, was there revaluation gain? Remember here, Paper Limited revalued the asset. There was a revaluation gain of 560, which we said is a pre-acquisition revaluation reserve. So we have a pre-acquisition revaluation reserve of what? Of 560. Yes, we don't have anything else. Let's get this total. Let's get this total. This will give us a total of what? This will give us a total of 40. So because you're using the full goodwill method, we take 100% of that. When using the full goodwill method, take 100% of this. We are interested with the net asset acquired by the parent and the NCI, parent and the NCI. So this will give us 40. So we less it from the figure we have up there, and basically we get the goodwill. We get the goodwill. So our goodwill will be what? Will be 320. Now, also you have to check, was this goodwill impaired? In our case, we are told as per the information we have in note number 4, the goodwill was not impaired. So I think having this now, I want us now we prepare what we are required. And because we have now the workings, all the workings, basically to prepare what is required should not take us a lot of time. So we go straight to part A, the consolidated statement of profit or loss. Let me just have that here. The consolidated statement of a profit or loss, which is for the year, which ended 31st of March 2025. 31st of March 2025. Yes, so here we just need to have a single column, and basically we indicate that our figures are in million of shillings. So how do we prepare this? As per our group structure, we are basically combining the revenue and expenses of the parent, those of the subsidiary. We combine the revenue and expenses of the two companies. It is also important to note that this company, taking into account it was acquired exactly the start of the year, we will take the revenue and expenses of paper for the whole year. For the whole year, we combine with that of the parent. In our case, remember, we don't consolidate a joint venture. Instead, what we will compute is the parent company share of the profit after tax, and basically we recognize it what here. So let's do that now. So how to prepare this, we go to the statement of profit or loss for individual companies, which is basically given below paragraph 2. And we use the format which are given there. So we will start with the revenue. We take that of the parent, 520, plus that of the subsidiary, which is paper, 51.80. So remember, we are not consolidating their joint venture. So and then to this, what do we need to do? We need to less any sales between the parent and the subsidiary. And I hope you can remember you have this intra-group trading of 500 million. We less it here. No any other adjustment. No any other adjustment. We get the final value. We try to hurry up so that we finish. Although I can see we have time. We have time. So once you get the answer, type it in the chat box. I'll be able to see it. So I'm told that will give us 13,200. 13,200. Someone else to confirm. Is it 13,200? Is it 13,200? Is it 13,200? Yes. So then below that, we take the cost of sales. We do the same. 5510 plus 3440. So to this, we have a number of adjustments to be made. One, we less this amount of intra-group trading, 500. So we also have this depreciation. Okay, this one will not be adjusted to the cost of sales, but rather to the administrative. We have this and this profit of 50 to be added there. And I don't think we have any other adjustment. So we get the final value there. The final value Final value, I'm given 85. I'm given 85. I'm given 85. Okay. So we move and basically we compute the gross profit. So the gross profit here will be how much? How much will be our gross profit? The gross profit will be 47. So then to that we proceed and basically we add the distribution. I think before we add the distribution, we can do this. We need to compute the group share over Sisters Limited profit after tax. Remember, this is basically a joint venture. That's what we include here as far as the joint venture is concerned. So what we need to do, can we go to the income statement, the statement of profit or loss of Sisters, and you give me its profit for the year or the profit after tax. The profit after tax for Sisters is how much? Is it 640 million? Yes, 640. Now, then we need to determine when was our joint venture acquired. You can see the date when it was acquired, this date here. 1st of October 2024. This is within the current year. The current year is added, the current year added on 31st of March 2025. How many months do we have here? Are they 6? So we have October, November, December, January, February, March. 1, 2, 3, 4, 5, 6. So in this case, we have how many months? Yeah, are they 6? Are they 6 months? Do we have 6 months? I've said 1st of October 2024. So our joint venture was acquired 6 months to the end of the year. So the parent company will only be entitled to share profit from the date it acquired that joint venture. It will only be entitled to share profit for how many months? 6. That's why we have to compute profit of 6 months, and then we multiply that with the parent company shareholding in Sisters, which is 50%. That gives us now the group share of Sisters Limited profit after tax. You think this one should be 160. This one should be 160. And then from there, let's proceed with the expenses. The first expense we have there is the distribution cost. And I hope you can be able to recall that if you come across these always a free mark. No single question for group accounts will come across whereby the distribution cost is to be adjusted. This is always a free mark. We take 830, that of the parent, plus that of the subsidiary. No adjustment. We get the total, which will be 1300. Which will be 1300. Are you getting 13? Yes. So then below that, we have the administrative expenses. Administrative expenses, we check that of the parent, 860, plus that of the subsidiary, 520. And then to this one, we have to add this depreciation added charge of 70 over 70. Also, in case our goodwill was impaired, in case this goodwill was impaired, any impairment loss for the current year, we also include it within administrative expenses, but we don't have any impairment loss. We get the final figure, which will be what? Which I'm told is 1450. 1450. Is it 1450? Yes. So then below that, we don't have any other expense. Okay, there is something we will include here. That one, you have to be very, very keen to remember that. Because I hope you can be able to remember, we have this deferred consideration. You see this deferred consideration, basically this represents what the parent company will have to pay at the end of the second year. So therefore, once we have discounted this deferred consideration to its present value, we have to amortize it. In the process of amortizing a liability, there is something which arises, which is known as interest. If you're amortizing a loan, if you're amortizing even, for example, financial liability, there is something which is known as what? Interest. So that interest is basically recognized here as part of the finance cost. So the finance cost will basically be the interest on this deferred consideration. How do we compute that interest on the deferred consideration? On the deferred consideration, we take this amount which you computed here, the present value of the deferred consideration. And for us to be able to compute the amount to be recognized as an interest during the current year, we multiply this with the rate which you have used to discount, which is 10%. 10%. So this will give us 110. Now, this 110 is the interest on deferred consideration. Interest on deferred what? Consideration. And then this interest basically should increase the value for this. So what I'm trying to avoid here is basically to prepare a amortization schedule, but I think I can do that very fast so that you understand. Amortization schedule. We are saying we should amortize this. You see, this is the deferred consideration at the start. This is like our own amortization schedule. You have a column for years, the liability at the start, the interest, the cash paid, and the liability at the end. No need of doing that because we know what we want to do. We want to compute the interest, which will be 10%. And then, is there any cash paid during the current year? No, no cash paid. So therefore, to compute the liability at the end of the first year, we take this plus this. Can you add for me that? So that you understand what we amortize this. So that will give us 1210. So in fact, when preparing our balance sheet, this is the value of our deferred consideration. The deferred consideration is a non-current liability, and that is its value at the end of the year. Then that will be the opening balance in the next year. And then we compute the interest, which is 10% of this. Will it come to 121? Is that what you're getting? Yes. Now we know the deferred consideration, this one, will be paid at the end of the second year. So at the end of the second year, the company will pay 1331. And once you do that, then you should get 0 there. You should be able to get 0. Will you get 0? Yes. Are you getting 0? Yes. So this is how we amortize that word. That. So basically, in relation to this deferred consideration, 2 items. One, this interest is part of the finance cost here, which is 10% of 1100. And then when preparing our consolidated statement of financial position, this one will be recognized as a non-current liability. Sasa? Yes. So having that, then we can proceed and we compute the profit before tax. Give me the profit before tax now. The profit before tax down here. How much would be a profit before tax? This plus this minus the 3 expenses there. I'm told this one will be 2,000. I'm told that one will be 2,000. Will be 2,000. Then we list the other item, which is also always a free mark. Income tax expense. Income tax expense, also this one, is always a free mark. A free mark. So no question for group account whereby income tax will be having adjustment. You take that of the parent and that of the subsidiary. And this will give us what? This will give us 670. 670. And basically we get what? We get profit for the year. Profit for the year, which will be 680. Which will give us which will give us what? 1320, yes. So basically in our case, we are done, and that's what was required. The marks allocated there were 10. So this basically what was to give you what? 10 marks. You can see in that question, it basically means that for any correct item which you had here, basically should be 5 marks, because these 6 cannot be 10. Yes. So having that, let's move to part B. The consolidated statement of financial position. Consolidated statement of financial position is at 31st of March 2025. Okay, so we prepare this one. We just need to have a single column here. And what is basically important for you to remember is that here, or this one is basically prepared by just combining similar items of assets and liabilities, those of the parent and those of the subsidiary only. As far as the associate is concerned, CSAS, we will include something called the investment in associate. So let's prepare this one. We start with the non-current assets. So for the non-current asset, we will start with the PPE, the property, plant, and equipment. So, and basically we take that of the parent 4260 plus 3660. And then you have to recall, we have an adjustment to be made to the PPE in relation to this working. So we said this 560 will be added to the group PPE, and then this depreciation other charge of 70 will be deducted from the PP. Two adjustments here. Two adjustments, we add the revaluation gain of 560, we less the depreciation at a charge of 70. We get the final value there. The final value will be what? What will be the final value? The final value, I'm told by Gilbert, will be 8380. 8380. That is the same figure I'm getting from Diana. So then from there, below that, we have investment in paper, investment in scissors. Remember, these are the purchase considerations which were paid by the parent company in acquiring shares of scissors and paper. Do you include that here? No. In relation to the subsidiary, which is paper, what we include here is the goodwill. We include the goodwill on acquisition of the subsidiary, which is paper limited. And basically, that's what we computed here, 320. 320. In relation to scissors, which is the joint venture, we compute something called the investment. The investment in joint venture, or basically joint arrangement. I just refer to it as the joint what? The joint arrangement. And basically we recognize that here is an item of what? As an item of non-current asset. I want us to have the working here, because remember I've given you the format for computing this. How do we compute the investment in associate or joint venture? I said one, you take the purchase consideration which was paid, or the cost of investment. That is basically what we have within the statement of financial, or within the statement of financial position of the parent under the non-current asset. How much purchase consideration was paid by the parent company in acquiring the shares of the joint venture? That is 15. That is 15. And then to this we have said we add what? To this we have said we add the group share of the joint venture post-acquisition retained earnings. And basically take into account our joint venture was acquired during the current year, scissors was acquired during the current year. The amount which we include here, which we have included here, that is now the same with the group share of the post-acquisition retained earnings of the associate. That is basically what we will add here, 160, this one. And then to this we less any impairment loss. And I hope you can be able to recall in note number 4, we were told that in note number 4, you are told the goodwill on acquisition, the investment in associate had not impaired. They were unimpaired. So we don't have any impairment loss. And that will give us what? 1660. That will give us 1660. So that basically what we include here. Then from there we proceed, and basically we record the current asset. So for the current asset, we are given the total. We will take that is 720. That is of the parent plus that of the subsidiary, 2270. And then in this case, you have to recall that inventory, receivables, cash, and bank balance are part of this. Any adjustment affecting this inventory and receivables should be made here. And I think you can be able to recall here, we have this and this profit, which we said should be deducted from the group inventory. Inventory is part of this. So we less an erased profit of 50. And also we have the amount of intercompany debt, this one, of 500. We also less it here. I don't think we have any other adjustment. So let's get the final figure. We get the final figure. I don't think we have any other adjustments. So what is the final figure here? I'm given 50, 440, 5440, 5440. Yes. So then what will be our total? What will be our total assets? What will be our total assets? You add all this, you give me the total assets. And because of space, I want to do away with this one. I want to do away with this one. Yes, the total assets in our case will be 15,800. I want to do away with this now. Yes. So then from this, we need to move, and basically we record equity. So for the equity, we will start with the ordinary share capital. ordinary share capital. And I hope you can be able to recall the ordinary share capital. We don't consolidate this. We only include the ordinary share capital, that of the parent company only. The ordinary share capital of the parent company only, which is how much? Which is 5,000. 5,000. Below that, what do we have? We have share premium. Equally, the share premium, we basically include that of the parent company only. That of the parent company only, which is 500. So below that, we have what? We have the retained earnings. So basically, retained earnings is one of the item which is a little bit tricky in terms of its computation. Maybe first of all, we can skip this one. We will come back and compute it. Then we will get what? We will get the total equity. We will get the total equity. And I hope you can also be able to recall your total in a part. These are some of the items you don't have to compute in an exam. They will consume a lot of your time, and you end up maybe getting that figure wrong. So, but we will come back and compute. We will compute that. Then down here, after getting this, we also come and we compute something called the non-controlling interest. I'll be able to explain what is this in the process of computing that, but we will compute this as the last two items. Then from there, we need to proceed and we record liabilities. I think for liabilities, we have the current liabilities, but in this case, there is something we are going to introduce. We are going to introduce non-current liabilities. I hope you can be able to remember this deferred consideration. These are consideration to be paid by the parent company in future. So that deferred consideration will be recognized here as a non-current liability. And basically, I've said the value for deferred consideration at the end of the day is this one. We have amortized that. So this amount plus the interest for that year, which will give us what? Which will give us 2110. And then finally, we have the current liabilities. Current liabilities, we take those of the parent 3,000 plus 19, those of the subsidiary. And then you have now to record that these include payables. Payables, we have amount of intercompany debt, which should be adjusted from the payables, this one, 500. So that one should be deducted here, 500. So give me the final figure. Give me the final figure here. The final figure for payables, for current liabilities. For current liabilities, I'm told is what? 44. Yes, 44. 44. So what I want us to do, I want us to compute these two items here very fast. Very, very fast. We should be able to do that in the next 10 minutes. We should be done. Yes, so we can start by computing what? Let's start by computing the group retained earnings. But basically, I've said, if, for example, you're doing that question in an exam and basically you leave it like that, you should be able to get all marks. You should be able to get all the marks. So let's start by computing this one. The group retained earnings at the end of the year, that is carried down. That is carried down. That is carried down. So how do we compute this one? How do we compute this? So the first thing maybe you need to remember is the formula. How do we compute this? So this one is computed by taking the 100% of the parent company retained earnings plus for this company here, that is paper, we should take 80% of a post-acquisition retained earnings plus 50% of sisters. I've said 80% of paper, limited post-acquisition retained earnings plus 50% of sisters limited post-acquisition retained earnings. Yes. That's basically how we compute that. So what basically we should do is to have 3 columns for our companies here, starting with the parent, which is log, the subsidiary paper, and the joint venture sisters. And basically in this case, we will take what? We will take the retained earnings as given in the statement of financial position. So we go to the statement of financial position, we take the retained earnings balance carried down as given in the statement of financial position. So can you go to the statement of financial position of these three companies, specifically at the equity? At the equity, we are given the retained earnings of rock, that 380. For paper, it is given as what? 1800, and for scissors is given as what? Is given as 12. So the first thing we need to do for these two companies, we are interested with the post-acquisition. So what we need to do for these two companies is to less the pre-acquisition. Acquisition. That does not apply to the parent. It only applies to these two companies. That's yes. And I think for this, what we will do, for this company, I think we computed the, for paper, we computed the pre-acquisition. The pre-acquisition retained earnings, which we have used in the computation of goodwill. How much was it? Give me that figure. We have computed the pre-acquisition retained earnings for paper. That is something we have already computed. Who can give me that figure? That retained earnings in tulitumia ku compute goodwill ya paper. Was it 1280? The one at the start? Yes. So this one we said is pre-acquisition. Is that the case? So pre-acquisition ya hii ni 1280. So we will less it there such that we shall be left with the post-acquisition. And then what about the scissors? Scissors, when was it acquired? I hope you can remember when scissors was acquired. Scissors was acquired 6 months to the end of the year here. Was acquired 6 months to the end of the year. 6 months to the end of the year. Basically, for scissors, we need to have, first of all, its retained earnings at the end. Its retained earnings at the end for scissors is 12, the value which we have here. Let's be together here. And then we also need to have the profit for scissors for the year. That one, we get it from the income statement. From the income statement, the profit for the year for scissors is 640. Silio? Yes. So can we first of all get the retained earnings here at the start of the year? So to get the retained earnings at the start, we will take this minus this, we get this. This minus this, we get this, which will give us what? Which will give us 560. So can we be able to get the retained earnings of scissors on this date of it was acquired? Just like how we computed this. It's quite simple. To touch this one at the start 560, and then we take for the whole year, which is 640. And here, because we have 6 months, we get half of this. We multiply that with 6 over 12. So we take 560 plus 320 plus 320 plus 320. That will give us what? That will give us, I hope you can see what I've done. I've taken the retained earnings of scissors at the start, which you have said is this, minus this, which will give us 560. And then for me to compute its retained earnings on the date of acquisition, which is pre, I've taken the retained earnings at the start plus the profit for the year for this 6 months, just like what we did for the subsidiary. So, and I'm told that will give us 880. So now we get the post. Basically, I've said this does not apply to the parent. So what do we get here? Because of time and track value, what do we get here? We get what? 520. What about this one? Is concern one. We will start by defining what is a company, and then from there we look on basically the various characteristics or features of the company, and then from there we look on basically the classification of companies. How do we classify companies? Because generally we do have different types of companies. We are going to look on those different types of companies. But in this case, I want us to start by defining what is a company. And basically, in this case, when we talk about a company here, this one can be defined to be an association, of persons, which is basically formed for some lawful common purpose and also registered in accordance with the Companies Act of 2012. 15. So therefore, this is what is association of what of persons, association of what of persons, which is basically formed for lawful common purpose, lawful common purpose, and also registered in accordance with the Companies Act of 2015. So that is the definition of a company. So what do you mean by association of persons? Association of persons, basically, this whereby, for example, we may agree to come together and basically we start doing business together. We start doing business together. So therefore, association of persons, this basically whereby we have a number of individuals, 2 or more persons will come together, they agree to register a company in order to undertake some business, which by the end of the day is legal, or basically a business which is what? Lawful. So that is basically the definition of a company. And basically in this case, we are saying that this particular association of persons, by the end of the day, it has to be registered in accordance with the Companies Act of 2015. Because if, for example, today we have agreed maybe to carry on a business, and that business will be conducted in form of a company. So by the end of the day, we must register that company in accordance with the Companies Act of 2015. And I hope you can also be able to recall what we said in our previous class. Previously, companies were registered in accordance with the Companies Act, Companies Act, Cap 486, but this particular act has been scrapped and basically replaced by the new Companies Act, that is Companies Act of 2015. You may come across some old notes which are basically talking of Companies Act Cap 486. So that act has already been repealed. Basically, it has been done away with and replaced by the new Companies Act of 2015. So today, if you to register a company, either a private company, a public company, you must register that company in accordance with the provisions of the Companies Act 2015. Now, this act here, that is the Companies Act of 2015, Companies Act of 2015, basically provides some legal framework, framework regarding, number one, the formation of the company, formation of the company. How should a company basically be formed? So that is clearly stipulated under the Companies Act of 2015. It also clearly stipulates issues to do with the management of the company. How should the management of the company be, or who should manage the affairs of the company, and how should those particular affairs of the company be managed? That is also something which is clearly stipulated under the Companies Act of 2015. And also we have the aspect of liquidation. So liquidation, remember yesterday I said that liquidation basically is the legal process through which the legal existence of the company is brought to an end. That is also something which is provided for under the Companies Act of 2015. How can a company be liquidated? What are the grounds for liquidating the company? And maybe the various types of the liquidation. Now, in this case, other than the Companies Act, which basically talks about the formation of the company, the management of the company, the liquidation of the company. So we also have various, or basically we have case law, or we have various case law. In this case, when we talk about case law, this in other terms we refer to it as the judicial precedent. So what do you mean by the judicial precedent? The judicial precedent, basically, these are those particular rules. Or principles, which the judges will come up with. After basically deciding various cases. So mean that other than the formation of the company, the company's management, and also liquidation being governed by the provisions of the Companies Act, we also have various rules and also principles which have been formulated by the judges, also which basically provide some legal provisions regarding the formation, management, and also the liquidation of the company. Therefore, we say that in different topics, we will basically come across various rules, or basically various principles which have been formulated by judges, and which basically governs the aspect of forming the company, management of the company, and also the liquidation of the company. But majorly, most of the provisions regarding the formation of the company, regarding management, and also regarding the liquidation of the company, they are basically contained under the Companies Act of 2015. And therefore, most of the things we will discuss in this unit here, they are purely contained in the Companies Act of 2015. Now, in this case, we can proceed and look on what are the features, or basically what are the characteristics of the company. So let's look on the features. Take into account, we have already defined what is a company. We look on the features, or basically the characteristics of a company. What are the features, or basically what are the characteristics of the company? Number one, we can talk about something called the separate legal personality. The separate legal personality. Separate legal personality. So basically what this means is that once, for example, you come together and maybe you have registered a company with the registrar of companies, that company becomes a legal entity, which is separate and also distinct from its members and also its directors. So once a company has been registered here with the person called the registrar of companies, in this case, we say that there exists a kind of a shell, or basically a kind of a shield, which basically separates this company from its members and also its director. So what that means is that if today we have agreed to register a company, once that company has been registered with the registrar of companies, the company becomes a legal entity. That's why you see that a company is legally recognized to be having the same status just like you. So if you register a company today, that company has to pay tax to the government just like you. That company has the capacity to enter into a contract just like you. So once, or basically what that means is that once a company has been registered, once the company has been formed, a company becomes a legal entity, separate and also distinct from its members and also from its director. So a company is not the same with sole proprietorship business, because if today you form a sole proprietorship business, that business is basically viewed to be the same with the owner. So if, for example, we come together, we form a partnership business, that partnership business is not separate from us as the partners. So that's why you see that if the partnership business is not able to pay its debt, the partners must come in and know how those particular debts will be paid. But in case of a company, if we register a company today, a company has that aspect of the separate legal personality. If the company is not able to pay its debt, those are not our debts as the members. So if the company has maybe entered into a contract, that is not our contract. If the company has some assets, are those our assets? No. So therefore, that is one of the characteristics, or basically one of the feature of the company. Number two, we say that the company has something called the limited liability. The limited liability. Limited liability basically means that if, for example, the company is not able to pay its debts, then the members of the company will not be required to come in and do what? Contribute money to pay the debts of the company. So in other terms, this means that the liability of members in a company is what? Is basically limited. It's actually what? Limited. So if the company is not able to pay its debt, then the members do not have any responsibility as far as the payment of those particular debts of the company are concerned. In other terms, we can say the debts of the company are not the debts of who? Of the members. So the members cannot be called upon to come in, contribute money to pay what? To pay the debt of what? To pay the debt of the company. So the other feature, or basically the other characteristic of the company, is something called number two. Also number three, that is number three, we have what? We have perpetual succession. Perpetual succession. Perpetual succession, or basically you can refer to this as permanent existence. Permanent existence. Permanent existence. What does this mean? Permanent existence basically means that once a company has been registered, a company based, or the life of the company is continuous. Because when we talk about something or continuous, this is another name for, sorry, perpetual is another name for continuous. The life of the company is continuous. The life of the company is continuous, or basically the life of the company is what? Perpetual. What this means is that if, for example, something happened to a member, or basically then a number of members, that do not in any way affect the company. That do not in any way affect what? The company. A company cannot be liquidated because maybe something has happened to a member. For example, maybe one of the members has died, or maybe one of the members has exited the company, No. So the life of the company is continuous. So once the company is formed, even if, for example, some of the members exit, some of the members are declared bankrupt, some of the members die, and they leave the company, that do not in any way affect the life of what? Of the company. It's not like a sole proprietorship business, whereby if the owner dies, that can lead now to the closure of that what? Business. Equally, like what happened in case of partnership. If maybe one of the partner dies, one of the partner maybe retires, that can lead to the dissolution of a partnership. That is not the case when it comes to the company. The life of the company here we are saying is what? Is continuous. So if a member exits or something happened to the member, that do not in any way affect what? The life of what? Of the company. Number 4, we can say the company has got something called the common seal. Common seal. So when talk about the common seal, this is basically equivalent to the company seal. By saying that the company has got a company seal or a common seal, it basically means that the company has the capacity to sign its documents, to sign its what? Its document, to sign its what? Its document. So for any legal document to be deemed to be authentic, that document must be having a company seal. So therefore, a company has a common seal. The company, or that means that the company has the capacity to sign its own document. And take into account the company itself does not have, or basically the company do not have that ability to sign, basically to sign the document. Any document of the company, for it to be authentic, we are saying it must be having what? A common seal. A common what? A seal, or a company seal. So the other feature of basically the company number 5, we can say that the company has the contractual capacity. The company has got contractual capacity. Contractual capacity basically is the ability. This is the ability to enter into contract. The ability to enter into contract. The ability to enter into what? Into contract. The company has the capacity to enter into contract. But basically, those contracts which are entered into by the company, are they entered into by the company itself? No. So any contract which is entered into by the company is entered into by its directors. By its who? By its directors. By its directors. So the directors are the ones who enter into contract on company's behalf. But by the end of the day, those are contract of the company. They are not contract of directors, because the directors here were acting as the agent of the company. They were acting as what? As the agent of the company. They were acting as the agent of what? They were acting as the agent of the company. So number 6, we can say the company can sue or be what? Or be sued. The company can sue or be sued. It basically means that the company here can go to a court of law, take a legal action on behalf of, or basically take a legal action against a third party. And generally, the company here, or the person who will be going to a court of law to take that legal action, is basically like the management, the directors, or maybe the company's lawyer instituting a legal action on company's behalf. The company can sue in a court of law or can be sued in a court of law. So number 7, we can say here, the company has capacity to own property. Capacity to own what? To own property. The company has got the capacity to do what? To own a property. So just like a natural person, the company has the ability, has the capacity to own the property. In fact, those particular property, those particular assets which are in a company, they are not assets of the members. They are basically what? They are basically the property or asset of the company. Simply, in this case, we have said that there is that aspect of the separate legal personality. If we have come together, we have formed a company. Those assets which exist in that company, those property which exist in that company, they are not our own asset, but basically they are assets of who? Of the company. So then the other feature of the company we can say is there's something called voluntary association. Voluntary what? Association. Voluntary association. So in this case, a company here, remember by definition, you have said is an association of persons. Association of persons. That association is voluntary. You can't be forced to be a member of a company. It's a voluntary. You must voluntarily accept to be what? Maybe to be a member of a company. You can't be forced. You can't be what? You can't be forced. The other feature of the company, number 9, is basically something called the transferability. Transferability of interest. Transferability of what? Of interest. When talk about the transferability of interest, it basically means that the interest in a company can be transferred. And how is your interest, or basically what is the interest in a company? Your interest in a company is basically measured in terms of the value of the shares you hold in a company. Once you are a member in a company, you have some interest, and your interest is equivalent to the shares you hold in a particular company. You can be able to transfer your interest. You can be able to transfer your shares. Though in some companies, like in private companies, the transfer of the shares is restricted. the transfer of shares is what? Is restricted. So restricted in the sense that you cannot be able to transfer your shares just to any other person. Just to any other person. You wake up today and maybe you decide that you'll sell your shares to any other person. There is some restrictions in relation to that. For example, in a private company, the requirement is that if you want to transfer or you want to sell your shares, you can only sell those shares to the existing members. You cannot sell the shares just to any other person. So the shares can only be transferred to the existing members. But basically, we are saying that there is that transferability of interest. You can be able to transfer your shares in what? In a company. So the other feature of the company, maybe number 10, we can talk over the aspect of management. The aspect of management. So who manage the company in this case? Who manage the company? So the companies basically are managed by an organ which is known as the board of directors. These are basically a feature which applies to all companies, that companies are managed by a board of directors. By a board of what? A board of directors. By a board of what? A board of directors. This board of directors basically comprises of directors who are elected by the members to be in charge of or basically to manage the affairs of what? To manage the affairs of what? Of the company. So therefore, this basically, among others, are some of the features or basically some of the characteristics of a company. Some of the features or characteristics of what? Of the company. So basically what that means that if you go to different companies, you'll be able to see those particular what? Features. So those features applies to various companies. So now, next, I want us to look on the classification of companies. Or basically, we look on the different types of companies which we have. Classification of companies. Classification of companies. And I hope you're together up to that point. Are we together up to that point? Are we together up to that point? Are we together up to that point? Catherine, are we together? Steven, are we together up to that point? Yes. Yes, so we are together up to that particular point there. Can see someone is having a question here. Yes, so I think we're going to discuss on that case of salmon versus salmon, maybe somewhere. Catherine, we're going to talk about the case of salmon versus salmon and the company limited. Almost at the end, there is somewhere we're going to look on the doctrine of separate legal personality in details, almost at the end of this topic. So we will discuss more on that. Okay, so classification of companies. Now here we have various ways in terms of how companies are classified. Various ways in terms of how companies are what are classified. Various ways in terms of how companies are classified, or in other terms, we can say we have different types of companies. We have different types of companies. So number one, we have the statutory corporations. Statutory corporations, or in other terms, these are known as the parastatos. So what do you mean by the statutory corporations or parastatos? So these are those companies which are basically formed pursuant to a certain act of parliament or in accordance with a certain act of parliament for them to be able to provide some essential services to the members of the public. And these companies here, usually they are under the control of the government, or they fall under the public sector. They fall under the public what? Sector. Public sector entities are those entities which are basically established to provide essential services to the members of the public. And on the other hand, they do not operate with an objective of making what? A profit. So therefore, these are those companies which are formed in accordance with a certain act of what? Of parliament. A good example of this is CASNEB. If you do some research, you'll be able to see that CASNEB is a statutory corporation which is formed in accordance with the Accountant Act. Which is formed in accordance with the Accountant Accountants Act. Accountants what? Act. Now, on the other hand, we have said that these particular entities are basically formed to provide essential services to the members of the public, to the members of the public, meaning that these particular entities, these companies are not formed with an objective of making profit. With an objective of making what? With an objective of making profit. And therefore, these particular entities will basically continue operating even if they are making losses. They are making losses because we are saying that their main objective is to provide some essential services to the members of the public. Now, in case they make any profit, that profit may be plowed back, may be reinvested back, or that particular profit may be paid to the government as dividends. Remember, these entities are under the control of the government. So if there's some of the parastatals basically make good profit, and basically what they do, they pay part of the profit they are making to the government as what? As dividend. So we are saying the profits they are making can be plowed back, can be reinvested back, or can actually be paid to the government in form of what? In form of dividends. So how is their capital raised? How do these parastatals raise their capital? These parastatals basically raise their capital through borrowing, and basically that borrowing is guaranteed by the treasury. So the government or the treasury is actually the guarantor. In case these parastatals are not able to repay back the amount of capital they had borrowed, who is supposed to pay that capital is automatically the government. So then from there we have the other type of company, and that is basically the registered. In other terms, we also refer to this as incorporated companies. Incorporated what? Companies. Incorporated companies. Now, when we talk about the incorporated companies, incorporated or the registered companies, number one, these are those companies which are formed in accordance with the Companies Act of 2015. They are formed in accordance with the Companies Act of 2015, and therefore, in a private company, the public company, and so on, they are the registered or the incorporated company. So these are those particular companies which will be formed and also registered in accordance with the Companies Act of 2015. So after these companies have been registered, after they have been registered with a person called the Registrar of Companies, they will be issued with a certificate of incorporation. They will be issued with a certificate of what? Of incorporation, in which case then these particular companies shall be regarded to be separate legal what? Separate legal entities from their members and also from their shareholders. From their what? Their shareholders. And actually, these companies here, their powers and also what they do, that is something which is clearly defined under their constitutions. And basically, these two companies, they have two main types of constitution. The first constitution is known as the Memorandum of Association, and the other constitution is known as what? The Articles of what? Of Association. So in other terms, you can say that they derive their powers from these two constitutions, the Memorandum of Association and also the Articles of what? Of Association. So then from there, we can proceed and look on the other type of companies, number 3, and that is the chartered corporations. Chartered corporations. Now, chartered corporations, these are those particular companies which are basically formed upon being granted a charter, basically by the president. Usually, the companies which fall under this category are universities. Are what? Universities, because basically what we know is that for any university to be able to offer various programs, various certificate, diploma, degree, master programs, it can only be able to do that upon being granted a charter. Upon being granted a charter by who? President. By the president, who is basically that under something called the Universities Act, the power to grant a charter to a university. If, for example, the president will be is basically of the opinion that that particular university will basically do what? Help the country in terms of development and promotion of what? Of education. So therefore, these are those particular companies, which are basically formed upon being granted a charter by the president, who we have said is empowered to do that under the Universities Act. And I've said good examples of this are what? Are the universities. Are what? The universities. Then from there, we have number four. Number four, we can talk of private companies. Private companies, or private company basically. Private word. So private company here is actually defined under the Companies Act, because one, a private company has to be formed in accordance with the Companies Act of 2015, and the Companies Act of 2015, private company, we can say a private company which by its articles of association, of association. So when talk about the articles of association of a company, articles of association of the company, this is actually an internal constitution of the company. An internal constitution means that this is a document which contains some rules and regulations regarding how the affairs of the company will be managed, regarding how the internal affairs of the company will be will be managed. So this is defined by its articles of association. Number one, restrict the right of members to transfer shares. So if, for example, you're a member of a private company, your right to transfer shares is usually restricted. So what does that mean? It basically means that if, for example, you want to transfer, or in other terms, to sell your shares, so there is some restrictions as far as that is concerned. And I think I've given a good example that if, in case you want to sell your shares in a private company, you can only be able to sell those particular shares to the existing members. You can't sell those particular shares to just any other person. So number two, we say, is a company which by its articles of association limit the number of members to 50, limit the number of members to what? To 50. Limit the number of members to 50. The number of members in a private company cannot exceed 50. And number three, is prohibited from inviting members of public to buy its shares, or in other terms, to subscribe its shares or debentures. So it basically means that in case a private company wants to issue shares, it can only be able to issue shares or even debentures to the existing members. It cannot be able to invite the members of the public to come and buy its shares or debentures. So therefore, this is the definition of a private company. So we have said it's a company which by its articles of association, number one, restricts the right of members to transfer shares, limits the number of members to 50, and number three, it is prohibited from inviting the members of the public to subscribe its shares or debentures. Its shares or what? Or debentures. Now, before we proceed to look on the other company here, we can proceed and look on the other features, or maybe we proceed and look on more features, or basically the various characteristics of this company, because it is important for you to note that this is basically one of the common type of company, which is basically formed by individuals to do business. In most of the cases, if today you want to register a company as an individual, you will be registering a private company. You'll be registering a private company. This is therefore one of the common type of company. So one of the features of this company, number one, is that private companies have a minimum, or basically in other terms, you can say, must have a minimum of one member and one director. One member and one director. So according to the new Companies Act, or basically according to the Companies Act of 2015, so for this company to be formed private company, it requires a minimum of one. But the repealed Companies Act, that is Companies Act Cap 486, it was requiring a private company to have a minimum of two members. But today, as an individual, you can register your own company as a single individual. So it requires a minimum of one member and one director. One member and one director. So that is one feature of this private company. So the other feature of the private company, we can say that this company can basically commence business upon incorporation. Incorporation is basically the process through which a company is registered with the registrar of companies. So once this company has been registered with the registrar of companies, remember you have said that the registrar of companies will issue something called the certificate of incorporation. That company can start to operate upon receiving that word, certificate. But we will be able to see if, for example, you are registering a public company, for that company to start operation, it's required to get another certificate still from the registrar of companies known as a trading certificate. But this company was registered, issued with a certificate of incorporation, it can be able to, or it can start, or it can commence business. So the other feature of this company, I think that is something I've mentioned here. It restricts the right to transfer shares. Right to transfer what? Right to transfer shares. So if you are a member of this company, your right to transfer shares is restricted. Now, this restriction for the transfer of shares is achieved in two ways. In other terms, you can say that this restriction regarding the transfer of shares is restricted in two ways. One is through something called director's discretion. Director's discretion. Director's discretion. Basically, what this means is that, or basically this document here, that is the Articles of Association, which you have said is an internal constitution. We have said it basically requires that in case you want to transfer your shares, to transfer is basically to sell your shares. So in case you want to transfer your shares in a private company, you must first of all inform the directors of that company. Inform the directors that you want to sell your shares. Now, once you have informed the directors are empowered by this document, by the internal constitution, basically to do what? To decline you, or basically the directors do have that particular power not to give you a permission, or basically a consent to go ahead and basically do what? Sell your shares. They can tell you that you will not sell your shares. You will not do what? Sell their shares. In other terms, once you have informed them you want to sell your shares, they can decline to register that transfer of shares. So once they have declined to register your transfer of shares, it means that you can't be able to go ahead and you do what? You sell your shares. So that is one way through which the free transfer of shares is restricted. Number two, it is also restricted through something called the pre-exemption clause. Pre-exemption clause. So this is still a clause which is contained in this document, Articles of Association, and which basically requires that in case you want to sell your shares in a private company, you must offer for sale those shares to the existing members. You can't offer for sale those shares to just any other person. This clause requires that you must offer for sale all the shares to who? To the or basically you must offer for sale those particular shares to the existing members of what? Of the company. This particular clause is meant to ensure that in case you are selling your shares in a private company, you are not just selling those shares to any other person, but basically you are selling those shares to who? To the existing shareholders of that company, to the existing shareholders of that wood, of that company. Yes, so those are basically two ways through which now this free transfer of shares is actually what? Is actually restricted. Maybe we can also say that or the other feature of this company here, number 4, we can say limit the number of members to 50. Limit number of members to what? To 50. So the number of members in this company cannot exceed what? 50. Cannot exceed what? 50. So those are basically some of the features of this private company. So then we can proceed and look on the other type of company. Remember, this was under number 4. So number 5, we have public company. Public company. What is a public company? Public company is also defined under the Companies Act, and the Companies Act defines this, or we can say that a public company, this is a company which by its articles of association, number 1, Number one, do not restrict members' rights to transfer shares. Members' rights to do what? To transfer shares. So in a public company, the right of members to transfer shares is not what? Is not restricted. And number two here, we can say that this one is not prohibited from inviting members of public to buy its shares. Not prohibited from inviting the members of the public to do what? To buy its shares. So this company can invite the members of the public to buy, or in other terms, to subscribe its shares or debentures. And we will be able to see that whenever a company is inviting the members of the public to subscribe its shares, that company does that by issuing something called a prospectus. By issuing a prospectus. A prospectus is any invitation by the company to the members of the public to buy or to subscribe its shares or what? Or debentures. Number three here, we can say its certificate of incorporation. Each certificate of incorporation clearly states that it is a public company. State that it's a public what? Company. So this is the definition of a public company under the Companies Act. Under the Companies what? Under the Companies Act. Specifically, if you go to, and this is a document, in fact, you should be able to download. If you go to any browser, you type Companies Act of 2015 PDF document, you should be able to get this act. Yes, so it's good you have this particular act, because I've said most of things we are running here, they come from this act. Specifically, for example, in this case, if you download this act and you go to section 10, of this act, this is where you get this definition. That's why you get this word definition. Yes, that's why you get that definition of a public company. Now, in this case, it is also important. There is something I've mentioned here in relation to the features of the private company here, where we have said a private company can commence business upon incorporation. Once a company is incorporated or registered with the registrar, it will be issued with a certificate of incorporation. We have said that this company can be able to commence business upon receiving that certificate. But this one, that is a public company, it can only be able to commence business after receiving another certificate called a trading certificate. Trading certificate is not a business permit, because some students tend to confuse this with a business permit. A business permit is you get that from the county government. So, but a trading license, this is still a license which is issued by the registrar of companies. But a company is only issued with that certificate, and that only applies to public company once the company has been able to raise something called minimum subscription. Minimum subscription is basically the minimum amount of capital which is required by the company for its operation. Once this company has been registered with the registrar of companies, it is required to issue a prospectus inviting the members of the public to start buying its shares so that it can raise the necessary capital. So automatically the directors will have said that, or basically will have agreed on the minimum capital required by that company. So once that capital has been raised, the minimum capital required has been raised through the issue of shares to the members of the public. That is the only time the company can be able to start operation. And once the company raises that amount of money, it is required to notify the registrar of companies that they have been able to raise the minimum capital required. Once the registrar is notified, then the registrar will proceed and issue that company with another certificate called a trading certificate. Upon the receipt of that certificate, that is the only time a public company can be able to start operation, operation. And therefore, that capital, minimum capital required, which you're referring to as the minimum subscription, is the amount of capital required by the company to pay the preliminary expenses. Preliminary expenses are the expenses which are incurred during the formation of the company. If today you are forming a company, kuna zile expenses incur. So maybe you need to pay, there is something called a stamp duty payable to the government. You also maybe the registration of or the formation of the company maybe is done by your lawyer. So he will be charging you some small fee. So all those costs you incur in registering a company, refer to them as preliminary expenses. So minimum subscription must be enough to pay preliminary expenses, must be enough to pay for any asset or property acquired by what? By the company, must also be enough to provide the company with sufficient working capital. So working capital is basically money required for operation, but maybe buying inventory, paying the day-to-day operating expenses of the business, and so on. So therefore, once this company has been able to raise that amount of money, it is supposed to notify the registrar about the same, and basically the registrar will issue that company with a trading certificate. A trading certificate. That is the only time this company can be able to start or operating. Yes. So are we together up to that point? If we are together, want us we move to the next thing. Are we together up to that point? Catherine, Steven, Zido, are we together up to that point? Are we together up to that point? Okay, so I want us next we look on what? We look on the features, not the features, Lana. I want us to look on the differences between these two types of companies. Differences between the private and the public. Private and public companies. So what are the differences? Which differences exist between these two companies? Which differences exist between these two companies? Remember, I've said these are the common types of companies which are formed by individuals to do business, either private or public companies. So which differences exist between these two companies? I think we have mentioned, we have come across some differences, like this one require a minimum of 1 member. For it to be formed, it requires a minimum of 1, whereas these require a minimum of 7 members, a minimum of 7. So this requires a minimum of 1 director, whereas this one requires a minimum of 2 directors. 2 what? 2 directors. The other difference is that this company, that is private company, is not required to hold an AGM. As per the Companies Act of 2015, a private company do not have any responsibility of convening. It may hold an AGM, but it's not a requirement under the Companies Act. But this company here must convene an AGM. And actually, we will discuss more on these meetings, on this meeting, AGM, in the topic of companies meeting. We will see what is an AGM, when is AGM supposed to be held, and basically which business are transacted during such meeting. So the other difference is that this company here, we have said, can commence business after receiving certificate of incorporation. This company, for it to commence business, we have said, other than receiving this certificate of incorporation, it must additionally receive a trading certificate. The other difference is that private company here, basically have said restrict the right of members to transfer shares. Restrict the right to transfer shares. But this one does not do what? Does not restrict. This one does not restrict the right of members to do what? To transfer shares. Does not restrict the right of members to transfer what? To transfer shares. On the other hand, this one cannot invite the members of the public. Cannot invite the members of the public to buy shares, whereas this one can do what? Can invite the members of the public to buy its shares. Can invite the members of the public to buy its what? Its shares. Can invite the members of the public to do what? To invite or basically to subscribe or to buy its what? Its shares. Maybe the other difference, we can say private company. Here, the directors are not required to obtain the qualification shares. Are not required to obtain the qualification shares. So the qualification shares, generally, these are the shares which the directors of the public company are required to obtain and pay within a period of 2 months from the date they were appointed. So that applies to directors of which company? Public company. So here the directors are not required to obtain the qualification share, but here the directors are required to do what? To obtain the qualification what? The qualification shares. So those are some of the differences which exist between the private company and also the private company and the private and the public company, private and public company. So next, I think we can look on like the advantages of a private company over public company. So what are some of the advantages of a private company over public? So we have a number of advantages. One, we can say that this company here, private company, can be able to commence business upon incorporation. So once this company is registered with the Register of Companies, it can be able to commence business. It can start operating. This company is not required to obtain trading certificate. That is one of the advantages. Number two, because for this company to start operation, other than being issued with a certificate of incorporation, it must then wait and acquire the other trading certificate. Now, the other advantage of this company is that for it to be formed, it requires a minimum of one. Meaning that to form a private company is much simpler because just one person is what is required. So the other advantage of this company, that is a private company, this company is not subjected to publicity requirement. What does that mean? It basically means that this company here is not required to, for example, one, publish its financial statements, make its financial statements available to the members of the public, which applies to public company. Public company must publish its financial statement, must make its financial statements available to the members of the public. Equally, in a public company, most of its documents, including MOA, AOA, and public documents, they are documents which can be accessed by any member of the public, which does not apply when it comes to what? When it comes to a private company. So the other advantage of this company is that private company is not required to hold an AGM. Remember, this is an advantage because if a company has to convene an AGM, we know that there are some costs which will be incurred, some logistical costs which will be incurred. The company must get a venue. Maybe the company will need to bring an MC. The company need to have other logistics put in place. All that means that the company will have to incur some expenses. On the other hand, if, for example, this company, the public company, fails to convene this meeting as required at the company's hand, it can be fined. It can be required to pay a fine to the registrar because it is not complying with the requirements of the requirements of the company's act. So those are basically some of the advantages of a private company. But on the other hand, we have various advantages of a public company over private. So what are some of the advantages of public company over private? One is access to capital. So if these two companies want to raise capital, the company which can be able to raise capital very fast and easily is the public company, because this company can issue shares to the members of the public, unlike private company, which is restricted from issuing its shares to the members of the public. So we can talk of easy access to capital. Number two is something called easy exit strategy. So if you have invested in a private company, it is basically easy to exit because you can just be able to sell your shares anytime and to any other person, unlike in a private company whereby your exit may be declined. Maybe you want to sell your shares, but the director tells you no, you can't sell your shares. In a public company, there is an easy exit strategy. So the other one is basically about spreading of risk. So in a public company, shares are issued to so many shareholders. So the risk has been spread to so many shareholders, unlike in a private company whereby shares are issued to maybe few individuals, to few individuals. And the other one is about the ease of selling the shares. Ease of selling the shares. If you want to sell your shares, you can be able to do that with ease. And there is no much restrictions in relation to that. In relation to that, yes. So that basically some of the advantages of the public company over private. Now, I want us to take a short break. I think we can just take a short break of 10 minutes, and then we come back. We look on the remaining types of companies, the other types of companies, and maybe we will wind up by looking on. We see whether we will be able to wind up on this. But basically, I want us first of all we take a short break. Then we come back after that short break of 10 minutes. We come back at exactly 1:18. We continue. Yes, so let's continue. I hope you're back. Yes. Are you back? Catherine, Stephen, Zido, are you back? So that we continue. Are you back? Okay, so I want us to continue with the discussion here. And I think we have just discussed on some of the advantages of a private company over public, and also the advantages of a public company over a private. So next, I want us to look on the other type of company, number 6, and that is the unlimited company. So unlimited company is what? So unlimited company basically is that particular company where the liability of members is unlimited. What does that mean? The liability of members is unlimited. It basically means that if, for example, this company that is not able to pay its debt, then what will happen is that the members of such a company will be required to come in and contribute money to pay those particular debts of the company. So meaning that this company here is just the same with a partnership, is the same with a sole proprietorship business. So the only difference is that this company one will be having perpetual succession, and also the company will be having the separate legal personality, but the liability of members is unlimited. Number 7, we have company limited by guarantee. Company limited by guarantee. And the company limited by guarantee, number 1, these are those companies which do not have share capital, share capital. Actually, this company have like 3 features. These companies, number 1, do not have share capital. What does that mean? It basically means that this company do not raise capital by issuing shares. Simply because mostly company limited by guarantee are the not-for-profit making organizations, like the NGOs which are formed, they fall under this category here. And basically what we know is that NGOs rely on donations. They are funded by donations, and also maybe grants from the government. Maybe, for example, the government a grant. They do not have share capital. They do not raise capital by issuing shares. Number 2, these particular companies here are not formed to make profit. Not formed to do what? To make profit. They are not formed to make what? A profit. And that's why I've said NGOs, they fall under this what? Category. And number 3, these companies or the liability of members. The liability of members is limited by what? Is limited by guarantee. Is limited by what? By guarantee. So by saying that the liability of members is limited by guarantee, it basically means that when these companies are basically to be formed, each member of this company basically make a commitment that in case the company is not able to pay its debt, then they will come in and contribute a certain amount of money to help the company in terms of paying its debt. So if you are a member here, so during its formation, you must commit yourself to contribute a certain amount of money to help the company in terms of paying its what? Its debts. That's what you mean by the liability of members being limited by what? By guarantee. So these are basically the 3 features of these particular companies here, which are company limited by what? By guarantee. So then we can proceed and look on the other type of or the other classification of a company, that was number 7. Number 7. So we have number 8. Number 8, and that is the company limited by shares. Company limited by shares. So when talk about the company limited by shares, these are those particular companies where the liability of members is limited by shares. The liability of members, liability of members is limited by shares. Is limited by what? Is limited by shares. So what this means is that in case this particular company is not in a position to pay debts, then as a member of this company, you will only be required, or basically as a member of this company, the obligation which you have as far as the payment of those debts of the company is concerned is paying the amount of money which you have not paid on the shares you have been issued with. For example, you have been issued with 10,000 shares. Maybe there is some amount of money you have not paid for those shares. So what you'll be required to do in this case is you pay that amount which you have not paid on your shares to help the company to raise money to pay its debts. That's basically what you mean by your liability being limited by shares. Your obligation as far as the payment of the company's debt is concerned is limited to paying any amount of money unpaid on your shares. If your shares are fully paid, then can you be required to come in and pay any amount of money here? Automatically, no, because your shares are fully paid. So that's what you mean by company limited by what? By shares. So then from there we have a holding company, holding and a subsidiary company. Holding and subsidiary company. I think in this case, we can start by defining what is a holding company. So holding company, essentially, this is a company which has acquired the majority of the shares in another company. For example, we are told 𝐻 Limited has acquired more than 50%. That is majority of the shares in B Limited. This company here is the one which is called the holding company. The holding company. In other terms, this one is also called the parent what company, the holding or the parent company. For us now, this company here is called the subsidiary company. It's called the subsidiary what company. So, but by definition, how do we define a holding company? So a holding company, this one is defined under the Companies Act, specifically Section 3 of the Companies Act of 2015. And actually, a holding company, we say, this is a company. Basically, we have 4 definitions. Is a company that number one controls the composition of the board of directors. Control the composition of the board of directors of another company. Controls the composition of the board of directors of another company. So a company is said to control the composition of the board of directors of another company if that company is the one which appoints majority of the directors. For example, A Limited, taking into account its whole majority of the shares in B, A Limited will be the one which appoints majority of the directors of B Limited. It therefore controls the composition of the board of directors of B what? Limited. Number 2, we say is a company that do what? That controls more than half. Controls more than half of the voting rights of another company. Voting right of another company controls more than half of the voting rights of another company. If A Limited hold majority of the shares in B, it basically means that A controls more than half of the voting rights in B in B Limited. And number three, holds more than half of the issued of the other, that is of the other company share capital. Other company share capital. So this company holds more than half of B Limited share capital. So therefore, this is the parent, whereas B is what? Is a subsidiary. And then number four here. Number four, we can say it is the holding company of a company. It is a holding company of a company that is of a company, okay, of a company which is another company holding company. So what have we said here? We have said that a holding company is a company that is a holding company of a company which is another company holding company. What does that mean? What does that mean? So let me illustrate that so that you understand. Assuming you have three companies, A Limited, which basically has acquired more than 50% of the shares issued by B Limited, and then this one hold more than 50% of the shares issued by who? By C. So in this case, you can see A controls B simply because this one has or basically acquires or hold more than 50% of the shares issued by B, and then B in turn controls what? Controls C. So this company controls this, and this in turn control C. So therefore, in this case, we can see A has got some indirect interest, not indirect interest, indirect control over C. A Limited has indirect control over C. So therefore, A Limited will be a holding company as far as company C is what is concerned. So this definition number 3, definition number 4 of a holding company basically applies to this. It applies to this, where we are saying A is a holding company of company C, simply because we are saying A is a holding company of a company, is a holding company of this company, is a holding company of a company which is another's what? Holding company. So this is a holding company of this, which in turn is a holding company of another company. So therefore, A Limited is a holding company of company what? Of company C. So that is the definition of what we refer to as a holding company. So if you come across a question required to define a holding company, you need to remember those 4 definitions. Those 4 what? Definitions. Okay. So next, number 10, which include the statement of profit or loss, the statement of profit or loss, and other comprehensive income, And number 2, we have the statement of the financial position. The statement of the financial what? Position. So these are the financial statements which are prepared by the bank or basically by the banking what? Institution. So maybe you can start by looking on how we prepare or what is a statement of profit or loss and other comprehensive income. So as the name suggests, statement of profit or loss and other comprehensive income, this one is basically prepared to ascertain the financial performance of a bank. So for us to know how a bank performed, what do we prepare? We prepare a statement of profit or loss. So therefore, this one is prepared to do what? To ascertain the financial performance of a bank. And actually, in this case, we prepare this to determine whether a bank operated at a profit or at what? At a loss. Operated at a profit or at a loss. And therefore, in computing this particular profit or loss, what do we need to do? We compare the incomes of the bank and basically the expenses of what? Of the bank. The incomes and the expenses of the bank. Now, the various incomes of the bank, or basically bank do have various sources of income or various types of incomes, which are generally classified into 2. We have the interest incomes, and then number 2, we have the non-interest incomes. The non-interest what? Income. So we have interest incomes, and number 2, we have the non-interest income. So when we talk about the interest incomes, these are incomes which are generated from, or these are the incomes which are generated from in form of interest, in form of what? Or these are incomes which are in form of interest, e.g. the interest on loans. So once a bank has given loans to the customers, so the bank will charge some interest. That interest charged by the bank to its customers is a form of an interest income. Equally, if you go to your bank and you take an overdraft, you'll be charged some interest. Also, on the other hand, what we know is that banks invest in government securities. Bank invest in government securities like T-bills and T-bonds. As a result of that, bank receives somewhat interest from those government securities. So therefore, this interest received from loans, the interest received from overdraft, the interest received from government securities, that is known as an interest income. On the other hand, we have those incomes which are generated by the bank and which are not necessarily interest incomes. What are good examples of non-interest incomes? Good examples of non-interest incomes include what we refer as the charges and commissions. Charges and what? Commissions, including fees. Including what? Fees. For example, if you have an account with a certain bank, anytime you're doing something like an EFT, electronic fund transfer, you're transferring money from your account to another account, will be charged some amount of money. Equally, for example, you are buying a banker's check, you are charged something called a commission. Something called what? A commission. So these charges, which the bank charges to its customers, these are still incomes, but they are not interest incomes. They are not interest incomes. Also, we have the forex income. So forex income or the foreign exchange income, this is basically the income which the bank generates from buying and selling the foreign currencies. From buying and selling the foreign currencies. If, for example, today I give you some US dollars, you want to convert them into Kenyan shillings, you have to go to your bank. When converting the bank, by the end of the day, will make some profit. So that profit which the bank gets as a result of buying and selling foreign currencies, we refer to it as what? The forex gain, the foreign exchange gain. So therefore, the incomes of the bank are classified into interest income and interest income. And the same case applies to the expenses. So we have the interest expenses, and also we have the non-interest non-interest expenses. Non-interest expenses. So maybe a good example of the non-interest expenses are like, for example, the salaries which are paid to the staff who are working in the bank. Those are expenses, but they are non-interest expenses. We also have rent. We also have other office-related expenses like maybe electricity, water, and so on. All those are non-interest expenses. But on the other hand, we have interest expenses. If, for example, today you are operating a fixed deposit account with your bank pay you some interest from the money you have put in your fixed deposit account. So equally, our bank here may have borrowed money from other banks. It may be paying some interest on that money which has been borrowed from other banks. So that is still an interest an interest expense. So therefore, in preparing this particular statement of profit or loss, another comprehensive income of the bank, generally what we do, we classify the incomes into two: interest income, non-interest incomes. We also do the same to the expenses, interest expenses, and the non-interest expenses. Now, before we proceed to look on how we prepare this one, the statement of financial position, I want us first of all we look on the format of preparing the statement of profit or loss and other comprehensive income for a bank. How do we prepare the statement of profit or loss of a bank? So we start by recording incomes. And always we start by recording the interest. We start by recording the interest income. We start by recording the interest the interest income. The interest income. So I've said that this is the income generated by the bank, which is in form of interest. I've said the bank may get now interest income from what? From government securities, from investment in government securities. So we can record interest income from government securities, maybe interest income from the loans, and maybe salary advances. So if you take a salary advance or even a loan from your bank, you'll be charged some interest. We also have the interest income. The interest income may be from things like maybe the overdraft, the bank overdraft, overdraft, etc. So all forms of interest income, we record them here, and we get the total interest, the total interest incomes, the total interest what? Incomes. So after getting the total interest incomes, before recording the other non-interest incomes, we first of all less the interest expenses. So before recording the non-interest incomes, we less the interest expenses. Interest what? Expenses. So these are the interests which are paid by the bank. For example, we have the interest paid on a fixed deposit account, fixed deposit account. Maybe we have interest which is paid on borrowings, So the bank may have borrowed, for example, in terms of issued debentures and so on, or other debt instrument. So we come and we less these interest what? Interest expenses, and we get something called the net interest what? Income. We get the net interest incomes, the net interest income. So after getting this net interest income, after getting this net interest income, we proceed now. We add the non-interest incomes. The non-interest what? Incomes. So these non-interest incomes, I've said, may include things like the foreign exchange gain, or basically you can just refer to that as forex gain. So the gain or the profit which the bank will get from buying and selling the foreign currencies. We also have the fees, the commissions, and also charges. This is basically the amount of money which your bank will charge you. Anytime you go to, you transact, you have a transaction in your account, you'll be charged some amount of money, like maybe anytime you're doing a transfer from your account to maybe another account, will be charged some money. So these are still incomes, but they are non-interest incomes. So we get the total what? We get the total incomes. The total what? Incomes. So after getting these total incomes, we proceed and we less now the non-interest expenses. The non-interest expenses, not all the expenses, because here I hope you can see we have already captured the interest expenses. So what we less here are the non-interest expenses. The non-interest expenses. So the non-interest expenses, these may include things like the administrative expenses, things like what? Maybe we can also talk about, for example, things like what? Things like maybe salaries is part of this. Maybe we can talk of things like maybe the depreciation of assets, etc. So, and we get now the profit. We get the profit before tax. We get the profit before what? Before tax. So now to this, we then proceed and we less the income tax expense, the income tax expense. And now at this level, you need to remember this income tax expense usually comprises of two components of tax. Based on what you covered in a PAN, CP intermediate level. So we have two components of income tax. We can be able to remember these two components of income tax. Douglas, Grace, Revis, can you be able to remember the two components of the two components of income tax? I think I've already mentioned one. Yes. Can you be able to remember this component of income tax? The two components of income tax, which are they? The two components of tax? Who can be able to remember? Yes. So we have two components. One of which is the deferred tax. The deferred tax. And basically the other one is what? Is the current tax. Is the current what? A tax. So which this deferred tax, it can either be a deferred tax expense, or the deferred tax income. So if it is a deferred tax expense, we less it. But if it is a deferred tax income, we do what? We add it. So the current tax, this one is always an expense. And we less it there. So we get the profit after tax. The profit after tax. So to this profit after tax, we come here and we add the other comprehensive incomes. The other comprehensive what? Incomes, the other comprehensive income. So this other comprehensive income, if you can be able to recall equally what you did in a fund, this comprises of things like the revaluation gain or loss, the revaluation gain or loss on PPE, the revaluation gain or loss on PPE, revaluation gain or basically loss on property, plant, and equipment. So a revaluation gain, we add it there. A revaluation loss, we do what? We less it. And what we get down here is the total comprehensive what? Total comprehensive incomes. The total comprehensive what? Income. So this basically how we prepare a statement of profit or loss and other comprehensive income for a bank, for basically what? A bank, for a bank. You can see this one is quite different from how we prepare the income statement for other business organizations. Other business what? Organization. I've said you just need to remember that format. We start with the interest incomes. We less the interest expenses. We get the net interest income. We add other non-interest incomes. We get the total incomes. And finally, here we less the non-interest expenses. We get the profit before a tax. We adjust that profit with the tax. We get the profit for the year. And finally, we add the other comprehensive incomes. So next, we can look on what is a statement of financial position. Statement of financial position. Now, a statement of financial position one, this one is prepared to ascertain the financial position of the bank at the end of the year. We prepare this one to ascertain what is the financial position of the bank at the end of what? Of the year. So therefore, this one is prepared to do what? To ascertain the financial position of what? Of a bank at the end of the year. At the year what? End. At the end of the year. It's also important for you to recall that anytime you are preparing this statement of financial position, we prepare this based on the accounting equation. We take assets, which will be equal to capital, but remember, capital is also known as equity plus what? Plus liabilities. Plus what? Plus liabilities. Plus what? Liabilities. So here we start by recording assets. Here we start by recording assets. And when preparing a statement of financial position of a bank, we don't classify assets are not classified. Assets are not classified. Assets are not classified as non-current and current assets. So we don't classify the asset as non-current and current. Actually, this particular standard here requires that anytime you're preparing a statement of financial position of a bank, we start by recording, or actually we record the asset in the liquidity order. In the liquidity order. Liquidity order is basically the order in which the asset can be converted into cash. The ease of converting asset into cash. So, and actually we start with the asset which are highly liquid. So we record this particular asset from the most liquid asset. So when talk about the most liquid asset, these are those assets which are either cash, or can be converted into cash within a very short period of time. We start by recording the most liquid asset to the least liquid. To the least liquid what? Asset. So these are those particular assets which cannot be converted into cash within a short period of time. And therefore, you'll be able to see when recording this asset, we start with things like the cash balances, and finally we record the long-term asset like the PP. Yes, but in that case, I've said what is important to note is that we don't classify the asset into a current and what? Non-current asset. So that is basically, I think, what is important here. And then from there, we record equity. Basically, we know equity. This one comprises of share capital plus reserves. So reserves include things like the share premium, things like maybe the revaluation reserve, things like the retained earnings, and so on. So after recording asset, which you don't classify into non-current and current, we record equity, share capital, and reserves, and then equally we record the liabilities. Equally, when recording the liabilities of a bank, we don't classify the liabilities. The liabilities are not classified as non-current and current. We don't classify the liabilities as non-current and what? As non-current and current liabilities. And I hope you can be able to recall the format of the statement of financial position. I don't think we need to repeat that, or basically we need to have that here. So when recording the statement of financial position, preparing the statement of financial position, we start by recording assets. And I've said these assets, we start by recording the most liquid assets, or can we say the highly liquid? The highly liquid assets. These are those assets which are either cash or can be converted into cash within a very short period of time. And finally, we record the least liquid assets. These are those assets which cannot be converted into cash within a short period of what? Of time. And then we get what? We get the total assets. I'll be able to share the format for this. No need to worry. No need to worry here. So then next, we record equity. We record equity, and basically at the equity here, we record the share capital and what? And the reserves. So basically, we know that reserves, these comprises of a number of items, share premium, the retained earnings, things like general reserves, and so on. And finally, we record what? We record liabilities. Equally, in this case, liabilities are not classified. These ones are not what? These ones are not classified as current or non-current. These ones are not what? Are not classified as current or non-current. And then finally, we get the total equity and what? The total equity and liabilities. The total equity and liabilities. And basically, whatever you get here is the total equity and liabilities. This one should always be equal to the total what? Asset. Should always be equal to the total asset. Should always be equal to the total asset. Total asset. Yes. So I think that basically what you just need to know as far as this one is concerned. This one is concerned. Yes. And I think with this, we can look on a question. There was a question which was there last sitting but one. Let's go to the sitting for August of 2025. Is it August? No, August is the last sitting. The sitting for April. Yes, so the sitting for April of 2025. April of 2025. That was a very simple question, which was from this topic. So once you get to the question, please confirm. If you have that question with you, you confirm that is August, not August, rather April of 2025. And specifically, this is the question number 5. This is the question number 5A. Question 5A. Question 5A. So if you're there, you confirm. Confirm. Just go to the chat box. You say yes, 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 yes. Yes, are you there, Grace? Okay. And so what are we told here? What are we told? We are told the following information. The following financial information as at 31st of December 2024 relates to 𝐎𝐍𝐿 Bank Limited. So we're given a number of items there. So we have the interest on loans and advances to customers. We have interest on deposit with other banks, interest on deposit from other banks, interest on customers' deposit, interest on loan from borrowing, interest on government securities, interests, that is other interest income, other interest expenses, fees, commission, and foreign exchange gain, administrative expenses, other operating expenses, ordinary share capital, share premium, revaluation reserve, retained profit as at 1st January 2024, loan loss reserve. Then we have the loan and the advances to customers. We have customers' deposit, long-term borrowing. We have the cash and balances with central bank. We have money on demand and short-term deposit, deposit with other commercial bank, deposit from other customers, or basically other commercial banks, equity investment, investment in government securities, property and equipment, intangible assets, other receivables, other payables, deferred tax, current tax payable, income tax expense, gain on equity investment. And then what are we required to do? Statement of profit or loss for the year which ended 31st of December 2024. And Roman 2, statement of financial position as at 31st of December 2024. So this was a very simple question because you can see there is no any additional information which is given. But even before we look on that question, maybe there is something I need to briefly explain here. Assuming you have a bank here, so usually a bank receives deposit from customers, deposit from customers. So once you have deposited money with your bank, that money to you is an asset, but basically this money now to the bank is a liability. So any customer's deposit to the bank is what? Is a liability. And then from there we have said the bank will be using part of this deposit to give loans. Still to some of the customers. So these particular loans which are given by the bank, because the bank expects the money to be repaid back to the bank, this is what? This is an asset. That is very important for you, first of all, to understand that. Equally, we may be told that this bank has received deposit. Their deposit received from other banks. Deposit received from other banks. So our bank here has received deposit from other bank. A deposit from another bank, this one is still a liability because money held by our bank, but it belongs to other banks, is a liability. Equally, in our case, we may be told that this bank here has deposited money with other banks. So any money which is deposited by a bank here with other banks, that is an asset. That is what? Is an asset. That is what? an asset. I think maybe those are some of the few items you need to understand. You need to understand that. Yes, and I think with that now understanding, we can be able to proceed and prepare what is required. We will start with part A. We will start with part A of that question, Roman 1, that is. In Roman 1, what are we required to do? We are required to prepare the statement of profit or loss for this bank. What is the name of the bank as per the first paragraph? The name of the bank is 𝐻𝐻𝐶, Bank Limited. 𝐻𝐻𝐶 Bank Limited. So this is what? This is a statement of profit and loss. A statement of profit or loss, basically, which is for the year, which ended 31st of December 2024. 31st of December 2024. That will be our title. That will be our title. And then the figures we're given there are in million of shillings. Here we just need to have a single column, not two columns, but basically a single what? A single column, a single column. And what do we start with? Remember, this being an income statement or a statement of profit or loss, we always start by recording incomes. But I've said the incomes of the bank, we classify them into how many categories? Into two. The interest incomes, non-interest what? Incomes. I've said always, we start by recording the interest incomes. We start by recording interest incomes. Interest what? Income. So we just need to go back to the information which we are given here. We see which interest incomes do we have. Which interest incomes do we have? Now, the first item in the trial balance, we have interest. We have what? Interest. We have interest. We have interest on loans and advances to customers. Interest on loans and advances to customers. So our bank here has given some loans to the customers. So automatically the customers have charged some interest. So that interest on loans and advances is an interest income. So we say we have interest income from what? From loans and advances to customers. And advances to who? To customers. And advances to customers. How much is that? It is 15 what? 1550. So below that, we have interest on deposit with other banks. So our bank here, that is 𝐻𝐻𝐶 Limited, has deposited money with other banks. It is receiving some interest. It is receiving some interest. That is still an interest income. So we have interest income on deposit with other what? With other banks. With other banks. So an amount of 472. Then below that, we have interest on deposit from other banks. So interest on deposit from other bank. What is this? Is it an income or an expense? This one is automatically an expense. Is that the position? Yes. Our bank here, that is 𝐻𝐻𝐶 Bank Limited, has received deposit from other banks. So our bank here is paying interest to the other what? To the other banks. So therefore, that is an interest expense. So therefore, we skip that one, but we put a dash or maybe an X just to know that we have not dealt with that. And then from there, we have interest on customers' deposit. Now, interest on customers' deposit, what is this? Grace, is it an interest expense? Is it an interest income? Who can tell us here? Who can tell us here? So interest on customers' deposit, interest on customers' deposit, yes, this one is an interest expense. The moment you are operating, you're operating what? You're operating a fixed deposit account with your bank, you are paid some interest. The interest which the bank pay you, to the bank is an expense, but to you is an income. So to the bank, that one is an expense. So that is an interest expense. And then we have the interest on long-term borrowing. So this is still an interest expense. And then we also have interest on government securities. Our bank has invested in government securities. It is receiving some income. So that is and interest income. So the interest on government securities. The interest received on government what? Securities. Interest received on government securities, is that an amount of 501 million? Is that an amount of 501 million? Yes, 501. So then below that we have other interest incomes. Other interest incomes. Other interest incomes. Other interest incomes. So the other interest incomes is an amount of how much? Is an amount of 200. So below that we have other interest expenses. That is an interest expense. And then if you check all the other items up to the last one, there is nowhere we are given any other form of interest. From where we have the fees, if you check all those items up to the last one, there is nowhere we are given what? We are given any form of interest. Yes. So in our case, these are the only interest incomes. These are the only interest what? Income. So what we need to do here is now we get the total interest incomes. We get the total interest incomes. So that then we proceed and we less the interest expenses. We less the interest expenses. We less the interest expenses. So first of all, give me the total